percent of Kenya's barrels of oil's reservoir, estimated at 2.85 billion, remains inaccessible for commercial exploitation due to limitations in extraction technology. This is according to British oil firm Tullow. A new audit on the Turkana oil fields revealed by British firm Tullow a larger reservoir, commonly referred to as oil initially in place in exploration parlance, compared to the previous estimate of 1.77 billion barrels. This comes after Tullow Oil presented a draft field development plan to Kenya for the Turkana oil project, reviving hopes for oil production. A development update report indicates Africa Oil and its joint venture partners plan to submit a finalized FDP by year-end, in line with license extension requirements provided by the Kenyan government last December. The commercially extractable volume climbing 585 million barrels from the previous estimate of 433 million barrels, according to the audit by British petroleum consulting firm Gaffney Klein Associates. The OIIP is different from actual proven oil reserves because it represents the total amount of crude oil that is potentially in a reservoir and not the amount of oil that can be recovered from commercial use. At the current crude price of $75.50 a barrel, the potential crude in the reservoir will be valued at 23.66 trillion shillings, equivalent to 2 times Kenya's DGP, while the proven commercially viable reserves are valued at 4.86 trillion shillings. Kenya would not, however, earn the whole amount when production starts, with a big percentage going towards production and shipping costs. For instance, Tullow estimates that it will cost 373 billion shillings to set up a crude pipeline and processing facilities on the oil fields. The firm is also entitled to recover its exploration costs from the crude sales, which further eats into the country's earnings from the commodity. Countries with oil deposits periodically update the estimates or recoverable reserves as extraction technology evolves. In the US, the development of better hydraulic fracturing techniques targeting oil deposits deep underground have helped double the country's oil production since 2006. Tullow added that it had made the higher estimates of extractable volumes due to a bigger facility processing capacity, additional wells to be drilled, and larger diameter crude oil export pipeline, which lowers the unit cost per barrel to $22 from $31 previously. The firm said based on the new plan, it will be able to produce 120,000 barrels of oil per day from an earlier estimated 72,000 barrels. Kenya has already tested the international market with shipments of crude. Tullow has yet to develop the field for commercial production more than 9 years after it fast-tracked oil in Turkana, attributing the delay to factors such as unfavorable global oil prices since 2014, approval delays for land and water rights, a tax dispute, and COVID-19 disruptions. The firm and its partners in the project, Africa Oil and Total, had initially planned to reach a final investment decision in 2019 and production of the first oil between this year and next year. Tullow has already presented the Kenya government with a draft comprehensive investment plan for oil production in Turkana, looking to beat a government deadline to do so by the end of this year or risk losing the concession. Tullow expects the Ministry of Petroleum to peruse the plan and provide feedback before it presents a final plan by December. Approval of the investment plan will see the firm kick off plans to build the infrastructure, including the 825-kilometer heated pipeline to evacuate Kenya's oil. Nancy Nelima, Look Up TV. Now, for a purpose